we're going to invite up Barbara and Christine. Give them a big hand, folks. You're going to be amazed when you hear about what they've got going on. I'm going to sit on this side just so I can see. Thank you. Sorry, I should have been standing there. Okay, so remarkable women. And we're so delighted that they would take some time, because I know both of them have very busy schedules. In fact, I think Barbara is going to be catching a flight right after this event, so another one of those Herculean efforts to be with us. And so we're very grateful. What we're going to do in terms of the format is we're going to talk a little bit about the subject matter of growing your net worth as a woman. And so Barbara's going to give us some data about the investment side. How do we look as compared to men? Are we effective at investing? If not, what are the things that we can do to improve? And then Christine's going to tell us a little bit about, now that we've generated this big pile of cash, right? How do we plan the estate management, once we decide to retire? So that's the subject matter for today. I'm going to start off with just a few questions myself, but I want you all to be thinking about questions for both of them, and we'll have some time to do that. We've got about 45 minutes or so before you turn into a pumpkin. So we're gonna expeditiously go through my questions and open it up for you, because this is all about what you can get out of this. And from my view, I hear so much about women and investing, and my entire career is about investing. And I think we're very good at it. I think we're underappreciated and undervalued for it. And we have a unique risk profile. But I think there's some great things that we can do despite our risk profile to produce a lot of wealth for ourselves, for our family, for the charities that we care about, because women give back to their community, and that's what we're here to talk about today. So with that, Barbara, I want you to tell us a little bit about your background. Barbara's the Chief Investment Officer for their private banking business in the Americas. And I want her to tell us a little bit about her journey, because it's an interesting one, and then we'll have Christine do the same.
So, well, first of all, thank you. Excuse me, I'm terrible cold. First of all, not to overdo it, you have to come see Sally Krawcheck. So I was on a panel with her.
She is a badass.
She really is. So she moderated a panel that I did for the Barron's Top 100 Women Advisors at the Breakers last winter, and I'm not kidding you, this woman is a world beater. I mean, you want to just be near her. She's just incredible, and she's invincible. So I want to come back out on November 11th.
Excellent.
So just to tell you just a little bit about myself, I started in the business in 1989, right after the 87 crash and right before the 1990 recession. And I started out in financial services at a firm called Smith Barney. And I was a financial analyst, and that was the big job to get coming out of undergraduate school. I went to a small liberal arts all-women's college back on the East Coast, and I sat down, and I was in no way, shape, or form qualified to be doing any of it, right? I could write, I could listen to the opinion of others, and I did not even know how to use any piece of software, which, by the way, at the time was Lotus 123. So now that I've completely dated myself on my 286, I did that for 2 years, and I decided that while I thought the organization was great, I wanted to really be at a big, bold bracket firm. So I put my resume out on the street, and I went to Morgan Stanley. And I stayed at Morgan Stanley for 20 years of my career. I know, it's shocking, right? I was the only, I came in as a senior associate. I was the only associate left in my class by the time I made managing director, and I learned a very important lesson through my 20 years at Morgan Stanley. It was all about learning to ask and learning to develop the skills to get your next job. And so many times women will come up and they'll tell you, I am now the chief investment officer, and my boss asked me to take on this job, and I was doing something different, and I was asked to do this next position. Well, I had 5 different jobs at Morgan Stanley, right? And you don't get from senior analyst to managing director without knocking on a lot of doors. I was never asked to do another job. Every single job I got was because I asked someone for it. And I asked someone for it by developing my skills and proving myself as an investor and making a whole bunch of investment mistakes. So my very first job actually stewarding capital was in 2000. And in 1999, I went on to an international equity program. And the portfolio manager at the time said, what would you do with European telecom stocks? And I had noticed that they were trading at really big multiples. They had declining average rates per usage, and they were doing silly things with the cash on their balance sheets. So I said, I would be underweight the sector. I don't think we should be, and if I could, I would short it. So he said, you're hired. I got hired onto the job. The first thing we did was we sold down every single European telecom position. It was October of 1999. Just to put it in perspective, Deutsche Telekom was at 15 euros at the time. And I thought I was going to be master of the universe. I'm like, this is going to be great. Give me the keys. I'm going to run the $10 billion. This is going to be great. The stock started to go up. And I called my husband every day and said, I'm definitely losing this job. I'm costing 500 basis points of performance. By the time March of 2000 had rolled around, I was responsible for losing 3% on the portfolio, on the bets, and was on my way to definitely being kicked out. We made all of it back in the first 10 days of March of 2000, when Deutsche Telekom, which had gone from 15 to 45, started crashing. And the portfolio manager that I worked for was a older person, had been in the business a long time, and he threw Deutsche Telekom's prospectus on my desk. And he said, I want you to tell me something that you learned. So I got out my black Sharpie pen, called my husband, said, I'm now definitely still losing my job. And I wrote across the prospectus, they're white with the red lettering on the front. I said, just because I'm early doesn't mean that I was wrong. And I wanted to be a badass at the time, so I taped it to the door to my office. And I went on to be, a co-manager on the fund, right? And it was a great experience. So, learning how to steward capital during very significant and downward bear markets is a very important skill. But the one thing that I learned about was this portfolio manager saw the expertise in the chart that I've got up there for you right now. And the expertise is that men and women have very different skills when it comes to investing. And the investment skill actually is brought out, and you can see it in the data. Women are better investors than men, right? So while men will tell you...
We knew that was the case. It's just good to have the data to back it up.
Whole thing. Well, look, if I look at the 100 best hedge fund managers, like 2 of them are women. Right? So they tell you that, they'll tell you, men are certainly more confident when it comes to investing. That may indeed be the case, but last year, women outperformed men by almost 100 basis points. And the problem is that men trial by fire. Churn, buy a stock, sell a stock, buy a stock, sell a stock, buy a closed-end fund, lose money, sell the closed-end fund, take the money back, buy something else. They turn their portfolios a lot because they don't have the same type of research abilities and the research capabilities that women do. And I will tell you, when you are making investment decisions, you don't have to do the research by yourself. All you need is somebody that knows how to do it and somebody that can help you with it. I don't expect anybody in this room to be able to manage their own finances, the same way that I wouldn't expect you to be able to go to a doctor and diagnose what the problem is if you have a bad headache, right? Go to a professional to help you. If you take one thing away from our comments today, it is asking for help. The second thing also is when it comes to saving, we win there too. Women are better savers than men are as well. Now that may be because we're going to outlive all of them, right? So, and the good news about that is we're better investors, so our money's going to last longer anyway. But I would say the following: a lot of women don't like to talk about money, and a lot of women don't like to talk about money because money is equated in our society with power. So it isn't a conversation that Christine and I ever sit down and say like, hey, I made X last year, or I made 500% on this trade last year. How'd you do, right? Everyone wants to talk about their winners, but no one ever wants to talk about their losers. So the big long story of this 26-year career before I turned over to Christine is as follows. Make sure that you have professional advice. Make sure that every year on your birthday, because everyone's got a birthday, right? You do 2 things. Change the battery in your smoke alarm. And the second thing, rebalance your portfolio, please. Just rebalance it back to, I don't care if it's in your 401k and it's a target date fund, or if it's you just pick up the phone and call your advisor and say, hey, how am I doing? Because the thing is, a lot of times you all will get so focused on your careers, and that's where I want you focused. but you don't pay attention to this big thing called your nest egg. And if you don't pay attention to it, it can be problematic for you at some point. It can be problematic because you got a big tax bill. It can be problematic because you're at a point in your life where maybe you want to take a couple of years off before your next opportunity. So you want to make sure and watch it. Don't ignore your nest egg. It will go away. So the point of it is that I want you all to either A, look at your portfolio or call your advisor on your birthday after you change the smoke alarm battery.
Excellent.
With
That's a
that,
great
I'm turning it over
introduction.
to Christine.
No, that's great. And you know, it's funny because we capture this data for our industry too, right? I work in venture capital, and you know, we work with entrepreneurs, tech entrepreneurs in particular, and return on invested capital for investments made in women-led businesses is higher. Women-led businesses tend to produce higher revenue, manage their cash more effectively because they don't take these wild risks, and produce, as I say, a better return. So more profitability and a better return. So it's consistent with what we see in our industry as well, across the investment banking industry, which I think is encouraging.
Women are better at everything.
Women rock. We
So
rock.
better at everything.
Just pat each other on the back and say we rock.
And of course, so this is also why I have a team of all men, right? Because I like to boss them around and tell them how great I am.
Okay, Christine. So Christine is the director for Credit Suisse and their wealth planning group, which is within their private banking North America business, and she's going to tell us a little bit about her journey.
Sure. So I've been with Credit Suisse for 2.5 years now. Prior to that, I was in private practice as an estate planning attorney. And to actually second Barbara's point about hiring professionals to do certain things for you, I really can't emphasize that enough. As an estate planning attorney, when I actually practiced drafting documents for clients, I had a lot of people come to me and say, even though they've been recommended to come to me, say, why should I pay for you when I could do this on LegalZoom or some other,
That's
I hope there's
humiliating.
nobody from LegalZoom in here. Pardon if there is. But the fact is you don't know what you don't know. It's not that you're not all smart ladies, but you probably don't have the time to do all the research and study, you know, the 3 years I did in law school plus the dozen years of practice to know all the ins and outs. And if you hire the right professionals, then you'll get it done right, and then you can rest easy. And, you know, like Bar said, you got to pick it up every once in a while to take a look at it, just like with your finances, you do with your estate plan. But for the most part, if you get it done right with the right people in the first place, then you'll be in a very good position. So, as I mentioned, I'm an estate planning attorney. At the bank, my focus is on talking to our clients and prospective clients on what they need to do for their wealth plan or estate plan. That can include very basic things, and it can include more sophisticated techniques depending on where you are in your family and financial situation. My focus has, generally speaking, been with high net worth clients, but I had private practice for a few years as well, and at that point, I call them the regular Joe clients, and that was people who had maybe had a very small amount of money to start with, but they were going places, and the goal was to try to help them understand how to preserve and then protect those assets for the benefit of themselves and for their children or other family members.
Excellent. What's a high net worth individual, by the way?
Depends on who you ask. Yeah, I mean, it really varies, right? You know, the way I look at it is the basics of estate planning, everybody needs. I mean, everybody. I mean, anybody definitely in this room, and, you know, from, you know, your regular people in your community to the Bill Gates of the world, those people need estate plans. And the level of detail and complexity depends on how high net worth you are. But in some fashion, from my world of estate planning and estate tax, there actually is more of a defined threshold. So you may have knowledge of this already, but I'll give you sort of a primer on our estate tax. In the US, we have what's called the federal estate tax, and it's basically a tax on your assets when you pass away. You have an exemption from this estate tax. It's usually referred to as a estate and gift tax exemption. And that exemption right now for an individual is $5,430,000. If you're married, you basically double that. And as that married couple, you can give that much away. So we're looking at, as a married couple, almost $11 million. If you have beyond that, then you're going to have to pay an estate tax when you pass away, actually upon the death of both you and your spouse. And that estate tax is a rate of 40%. So that's pretty high.
Yes.
So yeah,
Yes.
I mean, it's pretty shocking. And I think if you're looking at what's high net worth, then that can be at least one metric to look at it. If you're underneath that $11 million, then your planning may be a little less sophisticated in advance, but still planning is essential. If you have above that, then certainly you need to be sitting down with an estate planning attorney of your own to talk in detail about what you can do to minimize taxes.
Well, and we're going to get into the detail of this, but what's your 1 or 2 words of advice that you would give everybody?
get
If
2
you don't hear
words.
anything else that you want them to take away from this session, what will that be? And we'll get into details.
I think the easy thing is to talk to an estate planning attorney. Make that meeting with that person and find out what you in particular need to do, because what you need to do varies based on your family situation and your financial situation as well.
Very good. All right,
And
great.
if you don't know one, your advisor knows one. And if you don't have an advisor, get an advisor, and they will get you one. That's the most important thing, because remember, you lose money over 3 ways. You lose money by fees, inflation, and taxes. So, and taxes by far and away is the single biggest chunk of it. And also protecting your assets too, right? Like, so I had a full-blown estate plan done for myself after the birth of our child, right? So, because I wanted to make sure that, you know, assets would be efficiently passed on, you know, as a parent, right? So there's lots of things to do at all different data points in your life. When you're single, when you get married, when you have a family, when you buy your home, all those things are really important check-ins for a estate planning attorney.
Right, and it's not, I mean, we talk about finances based on the, you know, the topic for today, but a lot of it in my perspective as an estate planning attorney, it's not about preserving just the money. It's about preserving your goals, your wishes, your hopes and dreams for your family. And for people who have kids, you know, it's usually the concern is who's going to take care of the kids, both financially and who's going to live with my children and take care of them and raise them the way I'd want. That's a huge part of taking care of your estate plans, figuring out who's going to be in charge. And if you don't have kids and you want to think about what can you do to protect yourself personally. So for example, there may come a point where you're incapacitated. And that could be, you know, something tragic like an accident where you're temporarily incapacitated, or it could be long-term because of, you know, advanced years and a lot of times diminished capacity mentally. If you have a document in place that basically names an agent, or sometimes that's referred to as your attorney in fact, you name this person, you pick it, this person, while you're alive and competent, and you say, this is the person in charge of taking care of me physically, making decisions for me about my doctors, where I'm going to live, what kind of care I need, and also who is the person who's going to be in charge of my finances for me while I'm not able to do it myself. So it's not just about preserving your wealth, it's about preserving your dignity and your wishes.
And we're great planners, right? I mean, we plan, right? So this is an easy one for us to do. So tell me, just to jump back to Barbara, you know, we're going to focus on our investment strategies and how we need to be thinking about our money as we're trying to build an estate for our future. What's the deal with women not really being present in the investment world? Why are we missing in action given the data that you've shown us?
You know, I think at the most professional ranks, I read a really interesting article in the Sunday Review in the New York Times last week. And it was it's not about men or women in the workforce, but I think it speaks more towards women than it does men. And it was about the culture of work. And this culture of work article was amazing. And it said, look, the culture of work has always been part of the American fabric, right? We're always hardworking, we roll up our sleeves, we work the long hours, all that kind of good stuff. And that's great. And in the 1950s and 60s, and even into a certain part, the early to mid 70s, there was a great way to do that. And it was called the stay-at-home wife or mom, right? But the whole change of women entering the workforce changed all of those dynamics, right? And she's not coming back, right? Like, she's in the workforce now and she's not leaving.
It's never coming back.
Exactly. So I think we've got to evolve from not only a culture of work, I think we also have to morph into something about a culture of care and a culture of flexibility. And that means that husbands and boyfriends and brothers, while we're at it, right, have to pick up the slack on aging parents and on small children. And, you know, I think that it has to be a change that happens to it. Look, I picked finance because I was really good at math. It comes really easy to me. And I wanted to either go on and do my graduate work in mathematics, or I wanted to go to the street where I could actually use it, right? And so I picked coming to finance because I thought that finance was going to be the best way to do it. And one of the best ways that I learned all about math, baseball, right? So I did slugging percentages, and I was a big Yankee fan, and
Moneyball.
exactly, it just came easy to me. But I think that we have to do more to support. I think we have to do more to support women across every single industry, because it's not just finance, right? It is every single facet of every industry that I come across, because I get to see a lot of entrepreneurs. Where are you, right? Like, if I do if I look at 10 entrepreneurs that are coming to us for financial help, 8 out of 10 of them are men. Where are you, right? So make sure that you are stewarding your capital. Make sure that you are in charge of the finances, because every single person in this room is going someplace, right? You wouldn't be in this room if you weren't. So if you want to really have your seat at the table, you don't have to be really good at math. You just have to be brave enough to be able to want to be engaged in the conversation.
So we have a lot of entrepreneurs and VPs, executives in this room. Why is it challenging, or is it challenging for us women to invest our money? Is it, we set it and forget it, or are there other things that prevent us from engaging?
Lord knows we are all stretched pretty thin, right? I mean, I'm sure all of you have a to-do list that's probably a mile long when you leave here today. So we don't make a lot of time for a lot of things, right? So, and you don't even have to make a lot of time for your finances. You just have to have a financial professional help you, because that becomes their responsibility, right? That's what I do for a living all the time. I think the other thing, and I brought it up just very subtly, money is power. And women traditionally shy away from that conversation. I have been in client meetings with families where the husband and the wife built the business together, and she is silent. And I'm always thinking to myself, I'm like, but that is not the way that this business was built. This business is not built you keeping your mouth shut, right? So I always make sure and try to engage every participant in the meeting. Sometimes families come in with children. That's very important as well. But just make some time for it, or make some time to have a conversation with your friend and ask for referral. Who's your financial advisor? Who do you go to for your advice, right? I've got people in the room here at Credit Suisse today that would be happy to talk to any and all of you, right? So I think the important piece of it is you have to just get comfortable with an uncomfortable subject. And if you think it's an uncomfortable subject in the US, you should go to Europe. No one wants to talk about money, right? So I think it's just, you have to get comfortable. You have to become more comfortable that you're doing it. So instead of next time that you're having a conversation with your friend, right, tell them what you earned last year, right? And celebrate it, right? Because men do this all the time.
They do. They pat each other's on the butt. They go, they go, wow.
They're having a great old time. Right. So, and I think the other thing is also there is a fear that comes along with finance, though, and your personal finances of just don't lose it. Right. We've been through a really tough time for the past 15 years. Right. So 2000 through 2002, tech bust and Enron WorldCom MCI, which is a bunch of guys running companies, fudging the numbers. That was a nice big 49% decline in the S&P 500, and then the global financial crisis. Peak to trough, 57% decline in the S&P 500. Those are what we call secular bear markets. Secular bears happen, right? Secular bears are greater than a 30% decline in the S&P 500, right? A normal garden variety correction is like 20, or a bear market is 25%. This is when you get into like a jungle variety. To have 2 of those in a 10-year time period, so if you started from 2000 and until the end in 2009, is virtually unheard of. I'd have to go back to the 1870s when there were like serious bank runs all the time. So it has scarred a generation of investors. It has scarred a generation of investors that are just a little bit older than me that have said, I'm never investing in equities ever again. And you see it. This year alone, $95 billion has gone into fixed income funds. Do you know what that has delivered you this year?
Like 1%?
Zero? A goose egg to negative, right? Bonds have done nothing this year. And do you know that the same $95 billion up until May was redeemed out of equity funds? It is a cultural issue that you had 2 death-defying events for investors in such a short time period that has left a lot of people scared. That's why women, and I think a lot of investors are just nervous about just don't lose it. Now, academic work tells you it takes 25 years to forget a secular bear market, right? So the secular bear that happened in the Great Depression, it finally bottomed at right after World War II. Let's say the trough was finally 1952. From 1952 straight through until 1969. You had a nice big bull market, and then it just wiped everybody out again. In the 1969 to 1982 was another big, long 13-year bear market. That ushered in a very big march upward, but I can tell you there was a very broken generation in the very beginning of the 80s that said, I'm never owning stocks ever again. They never win. So I think you've got to break out of the psychology mode. Now the good news is that technology shrinks the time decay on everything. So maybe 25 years, where when the academic studies were done back in the 90s, now shrinks to maybe 10 years, right? But we're still probably 10 years away of everyone saying, literally, my phone will ring off the hook. The market's down like 2, 3, 4%. My phone starts ringing. I'm like, here it comes. Everyone's like, we're down 5. We're down 5. Is it on the next 15? Is it 15?
Oh, wow. Oh, wow.
Is it going to be 20? 20? Mortimer, sell everything, right? So there's a real psychology to it. So the best defense against that psychology is diversification. Diversification always wins. And I'm going to just give you one last thing before you all, and I've just completely just bored you all, but here, listen to this. If you didn't even pay attention to me or to Credit Suisse, and you just said, I'm going to have a portfolio of 60% S&P 500 and 40% fixed income, municipal bonds, which you need in the state of California. That portfolio, peak to trough in the financial crisis, fell about 22%. It had made all of its money back from its 2007 high by November of 2011. Right? So you had made it all the way back. The equity market didn't go all the way back to its all-time high until March of 2013. That diversification gave you 14 months of free riding on the market. It's the ultimate free lunch, right? We all say in finance, it's all a random walk and there's all efficient markets. 14 free months of your money having fully recovered and continuing to grow, just because you had a diversified portfolio. And that's without any other thing like hedge funds or commodities or private equity, like some really interesting asset classes that can help. So a diversified portfolio can help combat all that academic work on 25 years of being afraid of a secular bear.
How many have equities in their portfolio? Okay, so half of the room. All right. So what's a good portfolio strategy? I mean, what would you advise this room, knowing a little bit about their backgrounds and their life cycles?
So I think we have to consider something that's going to be very tough news for everyone to hear. Bonds are not going to get us there. But equities aren't probably going to get us there either, right? When I look at the PE multiples right now, I need to see some serious earnings growth. Now this year, most of our leading indicators for earnings have been flat to not doing much of anything. There's a very good chance that indeed reaccelerates. I would say you probably still have at least 2 more good years of markets. If you want a great indicator to look at, the St. Louis Fed has a probability of a recession. That's what causes the big peak to trough declines in portfolios. Not knowing anyone's investment objective, but looking at the average age, this entire room should have at least 70% of their portfolio in equity or equity-like exposure. You're young. You're really young. I'm 48 and I have 70% in my portfolio, right? So it's a combination of hedge funds and equities, and the rest of it is diversified across other things such as MLPs or also into real estate investment trust and some fixed income. But bonds are just going to be there to be a diversifier. You have to remember, they're going to be there to kind of be like a ballast in a portfolio. They're not going to really do all that much to help us on the way up, but they help you on the way down. But just if your average age, this room looks like, if I had to take a median midpoint, somewhere around 35, you got a long way to go, right?
And now the 40-year-olds say, bless you, we love you. I'm going to look at you every morning when I get up and hear from you.
I'm 48. Everyone's young, right? So I guess so the thing is, when we think about it, look, everyone's investment objectives are different, right? Some people say, look, I have to take care of aging parents. I need income in a portfolio. That's a different conversation. But if you have at least 20 years to go in your career, right? You need a lot of equities to get you there, because equities are the only thing that's going to help you outpace inflation. Bonds, I can guarantee you, will not help you outpace inflation. And remember, inflation erodes your portfolio. If your dollar is only worth $1.01 in 10 years, but inflation ran at 3%, net, I didn't deliver anything for you. So just remember that. You have to take some risk, and you mitigate the risk by having more diversification around the entire portfolio.
Excellent. So we're gonna pause here because I want you all to ask specific questions to Barbara related to your investment profile, and then we're gonna transition to the estate planning. So if we could have our roaming mics so we can capture those questions. Where are our colleagues? David, can you roam? Because we've got a bunch of questions here. All right, we start in the back since that's closest. There's a hand right here in the back. Yeah.
Hi.
Thank you. Okay, hi. You mentioned getting a financial advisor and asking your friends for who they use. What is your advice if none of your friends and none of your family have anyone that they like?
You can call Elaine Myers at Credit Suisse. She's sitting right over here.
Thank you.
No, I'm really
She's
serious.
very likable. I know Elaine.
Yeah, I mean, look, can I tell you something?
Yeah.
Elaine, by far and away, hands down. Right? Call Elaine Myers.
Great, thank you.
Right there.
Perfect.
Okay. I just wanted to ask in regards to, I know that when I had my portfolio previously, I had requested that they sell off actually in 2006 any real estate and banking holdings. And I really had horrible pushback from my wealth management. And I know how that works is basically they're kind of passing their dogs on to you. They make more money, a lot of advisors, brokers make more money by passing off their stocks, in which are part of their underwriting and etc. It increases their revenues, and a lot of that was dogs. So I guess I want to hear how does Credit Suisse differentiate themselves from sticking you with the dog?
So there's one thing that you have to be mindful of in thinking about selecting your financial advisor. Brand means everything, right? So you want to be with a world-class brand. Nobody in this room, knowing that you're all in technology, right, should be picking own stocks for their portfolio unless they have that in their little side pocket where they say, this is my fun casino money, and this is no different than me going to Las Vegas for the weekend, right? Because the thing is, if you pick a stock, it's just, you might as well just be throwing it at a dartboard unless you really have researched the company, right? You should really be with either managed funds or managed exchange traded funds. Right, okay, so look.
Wealth management.
That's why I don't work at Merrill Lynch, right? So, yeah, I know. So look, I will tell you the following. If you call your financial advisor and you are telling them something that you want done, right? And they tell you, look, if you're just saying, I'm in a panic, I want to sell everything, that's a very different conversation than, I don't really feel comfortable owning the banks and I want out, right? You remind them who they work for, right? And you just say, the same way, nobody that reports to you, you would ever let them tell you what to do. Just be like, you work for me. So you tell them, I'm uncomfortable, I want out. Now I will tell you, at the bottom, so in July of 2002 when the S&P 500 was trying to make its bottom, everyone's like, just get me out, just get me out. I'm like, but the market's in capitulation, this is when you want to buy. So there is some emotional kind of pieces to it. But I would say that most people here should either be in passive exchange traded funds or some type of managed mutual fund product, because buying single securities is just a very difficult game, and you can't beat the market, right? Yes, you may own and buy a real high flyer, but for every time that you do that, you will end up losing your shirt on 5 others.
Here.
Hi, my name is Maria. I'm CEO of Roadgazer Entertainment Company, and I'm former engineer and director in Material Mobility. So I have a question about overseas bonds. There are now new companies formed which kind of crowdfund the overseas bonds packages. So would you recommend to use this? Because this helps to diversify portfolio and decrease the risk using the US bonds.
So in fixed income portfolios, international fixed income portfolios do offer diversification, but you have to put it in the context of the following. If you're a US dollar-based investor and your liabilities are in US dollars, you do take a risk by going outside of the US in fixed income, because US fixed income has a very different profile than global fixed income. So for example, Brazilian bonds this year, right? Brazilian bonds this year are really in tough shape, right? They're trading at 80 cents on the dollar, right? US municipal bonds are not. So I would say global fixed income is something that you take very small bites of, and it's far better. You should have a global view to your equity portfolio, but for fixed income, you should probably have a U.S.-centric view if this is where your assets and liabilities are.
Okay, so what is the maximum risk, like what we should be aware of investing in the overseas things? What things we should look for?
Yeah, well, so the riskiest parts of the international fixed income markets are emerging market debt. That is the riskiest part of the capital structure in the emerging markets. Then you have like Templeton's Global Bond Fund, which has some emerging markets and a lot of developed markets. So they'll own bonds in Spain and Italy and maybe Roche and maybe Nestle. And then the higher on the capital structure, or the less riskier that you get in within fixed income, goes back to U.S. investment grade, or U.S. high yield is riskier, U.S. investment grade, and then municipal bonds. Municipal bonds in a portfolio are generally used as a diversification practice against your equity holdings, because equities can be very volatile, and municipal bonds actually blunt some of that volatility so that we don't get the big screaming ups where we all say buy, 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 and the big screaming downs when we say get me out at any price.
Hi, my name is Alia Janjua, and I saw a financial advisor for the very first time a couple of months ago. My company went through a big acquisition. And what resources would you recommend for someone who's completely new to finance? And, you know, as far as being educated and understanding, like more like finance 101 for someone who's totally new to all of this.
So, you know, there was a very interesting, it's a little bit laborious to get through, but David Swensen wrote a great book on personal investing, right? He runs the Yale Endowment, and he wrote a great book maybe about 5 or 6, no, actually probably it's about like 8 or 9 years ago. Yeah, it's like probably like 10 years ago. So I would say, I can't think of the title of it at the moment. It was not Pioneering Portfolio Management, it was his book after that. He talks a lot about personal investments and personal investing. So that would be, I think, just a great resource for you to start out, because he talks a lot about why you own equities and how they help you outpace inflation, and why you own fixed income too. So anything that you can get your hands on by him in his book, I did the title of it is just escaping me at the moment. Does anyone remember it? I'll have to Google it. I'm sorry. Swensen.
David Swensen. Okay, hello. Here. Yeah.
So I have a financial advisor, and his performance has been better than what you have there. But it occurs to me, I've never really asked him about turnover. And I do see my email come, the Schwab emails pop through Gmail every once in a while, and I just kind of have this blind trust that he's managing what he needs to manage and turning me over at the right time. And so I guess, so that's question number one is there a good time frame to ask for or get some guidance from him on what his perspective is? And then the second one is around asset allocation. If I have an overall asset allocation strategy, do I need to rebalance still?
Okay.
Isn't that part of that strategy?
Yep. So a blind trust does not mean a trust that you should ignore, and very importantly. If he's turning over your portfolio, you have to remember 3 things that erode your portfolio are fees, taxes, and inflation, right? So if he's turning over the portfolio, I would want to see what his turnover rate is, right? Because I want to make sure that your portfolio wasn't turned 100% in 1 year, which means that you're paying undue transaction costs and taxes. You should definitely rebalance your portfolio. So rule of thumb is after very big up markets or very big down markets, your asset allocation will become out of whack. And that's a great time to rebalance. But I don't like to rebalance too often, because if you rebalance too often, you keep on triggering taxable events, right? Because you're always kind of, excuse me, taking on taxable gain. You could be harvesting short-term taxable gains. So the rule of thumb that I generally use is I rebalance my portfolio every 13 months. And I do every 13 months because I don't generate a taxable event every year. I would also ask him if he's using a blind trust for you. Ask him if he's using a tax advantage equity portfolio. There are portfolios that do tax loss harvesting on equity, so you pay less in taxes, and there are active managers that do that for you. So ask him if it's being taxed, if he is using a tax harvesting manager to at least keep your tax bill low, and ask him for his turnover. You know, it's an appropriate time to ask about your portfolio any darn time that you feel like it. Right? I don't care if you're calling this guy once a month or every other day. You are.
he's great at the outreach. It's just I have no idea what to ask and how to be a smart person. He tries to teach me, but there's so much.
That's okay. So ask him. So if you want to ask him if you want to ask him, I think, an important question, you should say, tell me what my portfolio has done over the past 1, 3, and 5 years, and tell me what the average annual turnover has been. And actually, the other thing is also ask him what the fee is that you're paying on the portfolio too.
Yeah.
Those are thoughtful questions.
Okay, we have a question here.
Great discussion. So I've always been, rightly or wrongly, lusting after getting in on an IPO. And so, but every broker that I've been with, and we've named a few, and I won't go into that, will never allow me that opportunity. So could you tell me what the secret sauce is, if I'm so inclined?
So the problem is that the initial public offering markets are not geared towards individual investors. And the problem is because there are very big institutional, so when you think about kind of the pool of assets in the world, there are probably about $19 trillion out there at any one given time in the US, right? Who owns a whole bunch of it? Fidelity, T. Rowe Price, right? I mean, these people are swinging the bat on hundreds of billions of dollars, if not trillions, in assets, right? I mean, Fidelity, I think, has like 1.9 trillion, right? So they're going to make sure that those institutional money managers always get the IPOs because they pay the most in commissions, and they're very, like anybody, they're kind of most favored clients, right? If you really want to think about playing the IPO market and you're not getting the shares, a very interesting, it's not a strategy, but you know, if you know the company that's going public and their IPO is ice cold, buy that, right? It's a very interesting way to kind of play it. Now look, some companies when their IPOs are ice cold turn out to be great winners. Some of them don't tend to be great winners. But I would actually maybe just resist that temptation if you possibly can and just put it into a spider in the S&P 500, which is going to end up benefiting. Or if you really want to get down to the IPO market, you can buy a microcap index. And microcap indexes are a lot like companies that have recently gone through IPOs because they're small, but they're really swing wildly. Like this again goes into the casino money category.
Okay, and we have a question here, but we have 1,000 questions.
Is this on? Okay, great. So I hate math, and I want to start there because so I get this long portfolio tracker from my financial advisor, and I just put it away every month because I have no idea what to look at.
Mm-hmm.
So I've had it for a long time too. I mean, I've been dealing with the same guy for years now.
Yep.
But I mean, I just open it up and I just look plus minus. All right, let's keep going. So for those that aren't as educated on the topic, and I really don't know what to look for, do you have a suggestion on just basics? And I took those questions that the other lady asked there as well. But so that's the first question. Second question, really quickly, is. So if you have kids, one of the things that I talk to him a lot about is I feel like I need to put more under my child. And he always tells me, no, they'll be fine.
Okay.
And it's always concerning to me.
Yep.
So just wanted your take on it.
So I'm going to have Christine answer the second question because that's a big trust and estates question that needs a professional answer. But I would tell you, so when you open up your statement, everything's generally on the first page. So the first page, right, like the first page after your name and address, right, like, there's generally an overall how your assets are allocated, and then it's how your portfolio did, right? So if you just take a look, all you have to do is take a look at the year-to-date number, right? Just look at the year-to-date number of your overall portfolio, then pull up your phone and type in SPY and see what that did. Same thing, year-to-date, that gives you a number right on your stock app, and just see how you did versus the overall S&P 500. Your portfolio isn't only the S&P 500, but at least it'll give you an idea of what's going on in the financial markets, and that's all you have to do, and it's on page 1. Now, the pie chart that is always on that first page as well for you, just make sure that there's not just one big blob of color. There have to be lots of colors, right? Lots of colors on the pie chart. But the kid thing, it's a great question. I'm so glad you asked it because you know what? I have a child. I have a small child too. And you know what? Like, I think about the 529 plan. I think about, like, I want to gift to him. I want to make sure that, like, if he wants to go on to medical school, he can. Or if he wants to be an artist, he can do that too. So, Christine, help us on that one.
Sure. is your question how to go about helping out your child?
So I have the 529 plan for him, but then
Okay.
I'm like, well, what else is there? Like,
Yeah.
that's one, like, what else? Because I want to make sure it's diversified, right?
And you want to make sure he gets your money.
Yeah,
Yeah.
definitely.
I would say that there's two ways to think about it. You could think about setting a trust up for him today where you're giving assets to that trust, and that's hopefully going to grow over time, and that pot of money will be available in some fashion for him in the future. So I take it he's a minor?
How old?
7.
Yeah, okay.
7. Okay, great.
Yeah, so you look too young to have an adult child. So, assuming maybe at age 18 you want him to have a little access, or maybe it's 25, maybe it's you never want him to have access, but you can define that today by putting together a trust and then funding it over time as you see fit. And that trust can be for anything. It could be for his education alone, in addition to the 529 plans, or you could say you want it to help him for starting a business under certain parameters. It could be buying a house or helping with a down payment. You can define it very detailed, or you can leave it kind of open-ended. Say that I'm going to entrust a trustee who you pick, and it's an individual that you name, that would make the discretionary decisions about when to distribute assets over his lifetime. So it's always in a trust available for him, but he's not necessarily ever going to get direct access. And that can actually be really beneficial for a couple of reasons. When a child is young, you don't necessarily know how they're going to be when they're older, right? They might turn out perfectly fine, making great decisions, or they might end up being too nice and trusting the wrong people. If you have their inheritance or what you want them to have from you, if you have that in a trust that's for their benefit, but they're not in charge of it and they don't have direct access to it, then you're protecting them from potentially making bad decisions about spending that money. And then the other thing too is, it's a pretty litigious society that we're in today. And when I was in private practice at a law firm, I also worked with other attorneys who did litigation matters. And a lot of times we had clients, maybe they were business clients, but then they were sued for hitting someone in a car accident. Bad things happen to nice people all the time. And in that instance, your assets and any assets of your child, if it's them who got in the accident, they are on the line for a judgment in a litigation. If you put those assets in trust and the child does not have access to them, but gets to be just a beneficiary on an as-needed basis, then if your child has that accident and there's a judgment against them for $2 million, that creditor isn't going to be able to tap that money that you set aside that's their inheritance. They might be able to get your child's other assets, but at least you have this nugget for them that's there for them for the long haul.
That's smart. Okay, so I know we have 2 more questions for Barbara, and then we're going to shift over to Christine and talk about planning. I know you guys want to know how to make your millions, and that's why you're asking. There's like 100 questions in here, seriously. But we're going to have to transition. So Patricia, and this one here, and then we're going to move to estate planning. So go.
Thank you. I have one comment and then one question.
Yes.
The comment is, I set up 529s for elementary boys, and it's paid for all of their college. So if you do one thing for your kids, set up a 529.
Bravo.
Bravo.
Smart.
They are good.
And the other thing I would say, I just wanted to learn a little bit more about international funds and what % of our portfolio we should have in that area right now.
Yeah, so international. So, back in the days of Peter Lynch and Fidelity Investments in the 1980s, when the world before was all globalized, you could diversify your portfolio by saying, I'm going to own some U.S. stocks, and I'm going to own some stocks in Japan, and some stocks in Korea, and some stocks in Europe, and those markets aren't going to move together. And then 1992 happened. And in the event of globalization, I think the thing that we really saw was that diversification no longer benefits because, and it's the same thing that you see, if there's a major shock with Apple, right, somewhere because of something, right, every Samsung gets hit too. It doesn't matter that Samsung is in Korea, right, but it's just, or Nokia in Finland, right? So they all get hit together. And it's because the world is increasingly exchanging information much faster. So the benefits of diversification for going international no longer exist. But there's another reason that you go international. Not every single brand in the US is the best, right? So when you think about the 10 sectors in the S&P 500, when I think about the single biggest automaker, who is it? Toyota. They're in Japan. When I think about the second biggest drug company in the world after Pfizer. It's GlaxoSmithKline in the UK, and then Roche is right behind it in Switzerland. When I think about, consumer staple companies that are selling, packets of coffee in the emerging markets to the tune of 1 every 3 seconds, it's Nestle. They're in Switzerland. So you go international because the U.S. doesn't have the monopoly on all great brand companies. There are many great brand companies outside of the U.S. too. But I would say in this era that we're in the go international period, you have to be a little bit careful about the emerging markets, because as we're going into a Fed tightening cycle, the emerging markets are going to get starved of oxygen. It just is that way. I've seen this unfold now twice, 2 other times in my career. And I think you just want to be mindful of that. So while we think about investing, we think about it in terms of where our assets and our liabilities are, right? Because if you invest internationally and the euro goes down, and it's the euro goes down, and those returns get translated into US dollars, you know what? Well, that doesn't help you very much. You don't pay your mortgage in euros. You didn't pay your child's education in euros. So sometimes it's smart to think about hedging using an ETF that actually is like MSCI Europe, but hedged back into US dollars. And I would say on average, most portfolios that I see probably have about 15% of their 15 to 20% of their equity exposure is in international investments. So out of $100,000, it's generally about $20,000 outside of the U.S. And I have a great deal of affinity for investing in all markets. I am blinded to where the company is or where the opportunity is. I just want to be able to make money. But I would say you have to be mindful that there are a lot of interlinkages that will cause markets to move together. So I think anything over 20%, you're taking a lot of risk, and then you're risking over diversification, which is the same thing as not diversifying at all. Because then the whole wheel, that instead of having one blob, it has like 15 different colors. Well, 15 is probably too many. So.
Excellent.
Okay.
Last question.
I have a quick question. I'm Mary Jean. I'm an entrepreneur, and I actually have my own stocks, just online. My perception is that I have to have a certain minimum level, or the fees and the charges will be too expensive, like they'll be more than the gain. So is there a minimum level that you look for in terms of taking on your clients?
No. So when we take on our clients, we take a look at an entire relationship, and sometimes the relationship, so I have clients that are very big relationships, and then we also manage the money for their great aunt, and it's a very small and modest portfolio, right? So, and again, I think Christine said it best when she's like, everyone in this room is someplace, but you're going someplace too. So I think it's penny wise and pound foolish to not take a look at any client, but I think the most important thing as well is in thinking about, kind of owning stock portfolios and turning them and stuff like that, for some of those assets, maybe you just want to leave them at Schwab. Schwab's something like $49 per trade or something silly like that, right? I can't remember exactly what the number is. But, I think that anybody that's charging fees that are that high, there's an advisor out there for every single person on the face of the planet. Right? So, and talk to them. I think the single biggest thing that we don't do when we shop for advice is we don't ask how much.
Excellent. Okay, with that, we're going to transition. And I know you have to leave, so if you need to.
Totally
Oh, you're good? Okay, good. All right, great. Okay, so.
I will leave if you want that.
No. Are you kidding? I'm telling you, we could talk for another hour just on the questions that you have here. So, but now that we've made our millions, then we need to preserve that capital, right?
Seriously, the smart woman in this room is to my left. Seriously, she will help you keep it.
How do you keep it? And so maybe talk to us a little bit about how you preserve your assets, the how, the who, the why on an estate plan.
Sure. So I think we did touch on it sort of through the Q&A a little bit here. Preservation, to me, really is about protecting it from bad decisions, right? So if you're talking about the inheritance you want your child to have, or the gift you want them to have right now, and it's not your children. It could be, I've seen a lot of folks who don't have kids who want to help a niece or a nephew, or they have a special needs sibling, perhaps. So it's a variety of people that we're referring to as beneficiaries of your estate. The preservation happens in how you structure what they receive. So a perfect example actually is if you have someone in your life who has special needs and you want to help them, that's a great idea, but if you just gave them a gift of, let's say I want to write a check for 100 grand that'll make their life easier, you could potentially be disrupting their benefits that they might receive from a governmental, whether it's California or federal governmental entity, and so that actually could disadvantage them. So it's a great thought, but there are certain ways that you can craft the gifts that you want to make, whether it's during life or at death, that will actually help protect that individual. We touched on children, how you might want to wrap it up in a trust, and that way they're not going to make the bad decisions about blowing it all at once. And sometimes, by the way, there is an in-between world, because I know a lot of people think, maybe you received something from your folks when you turned 30 and it was really great and you spent it wisely and you don't like the idea of locking up your gift indefinitely. There can be a middle road, and I actually advise on this a lot to say that, what is that chunk of money that you envision having your child spend on whatever they think is right, even if it turns out to be not the decision you would make, have that set aside in a trust that they get when they're, whatever it is, 25, 30, whatever you think is their responsible age. And then the rest of what you're going to pass on to them can be set aside in that kind of trust I mentioned earlier, where it's forever, it's held there for their benefit, even if they make poor decisions. So you can kind of split the baby on that one. Preservation from creditors, that's another topic. And it's not just tying everything up in a trust, because some people they want to keep things very simple. And a very simple technique, I think it's on our slide here, is the bottom one. It's protect your assets from creditors' claim with an umbrella policy. An umbrella policy or liability protection policy, to me, it's a no-brainer to have. I mean, literally, I have to imagine that every single person in this room could benefit from it if you don't already have one. And the concept is very basic. You have your insurance policies for car insurance and maybe homeowners insurance. Those policies protect you from liability. If you're sued in that car accident, they protect you up to a certain set dollar amount that you've paid for through your premiums every month. But usually, if an accident is bad enough, that policy threshold is really, really small. I mean, I would say that the average is probably like $250,000 to $500,000 of coverage. I mean, that's nothing. I've seen lawsuits where they're asking for $2 to $3 million. I mean, that's kind of common. It's not unheard of. So what happens then? If you get sued, there's a judgment against you, and your policy only covers $500,000 of that judgment. You pay the rest from your other assets. So to protect you from that, you can get these umbrella policies. And they're basically, they layer on the protection. So if you're sued and the judgment is, let's say, $1 million against you, and your car insurance covers that because it was a car accident, and it covers you for $500,000, then the umbrella policy, assuming your policy limits are high enough, it will cover that additional $500,000. So instead of that coming from your investment account, it's coming from the insurance company. And these things are, this kind of policy is so inexpensive. That's why I always say it's a no-brainer. I mean, it's so inexpensive.
Who do you go to?
So there's a variety of companies. I would say first step, and it's not the final step, first step is check with your current insurance carrier for your home and your car, et cetera, boats, whatever you may have, and ask them what it would cost. Because sometimes when you work with your same insurance company in multiple coverages, they'll give you a discount. If you're looking at a big policy, and people often ask me, like, well, how much is enough? There really is no right answer. It's partially based on what your net worth is. I mean, there's no sense in covering more than you're worth or think you're going to be worth in short term, but you do want to have a significant enough policy so that if something very tragic happens, that you know that this set amount of money is not going to be touched. That's yours, and no one's going to get that in that lawsuit. So that's where the liability coverage comes in. And for example, outside of your regular State Farm or whoever it is you use on your car and home, you can go to professionals that work with clients who have a greater need for high policies, like $5 million, $10 million policies. And those are Hub International and Chubb. They're both good companies that I've worked with, and they just specialize in the high net worth area.
Another thing I hear a lot is tax reduction strategies. So when we do tax reduction, and then we'll open it up for a couple of questions before we wrap up.
Mm-hmm. So, I mean, the tax reduction strategies are kind of funny because you have to get on board with the idea of giving something you have now away. Because you're either giving it to an individual or you're giving it to charity. And if you're not feeling comfortable with that, then you can sort of stop short, right? You're not there yet. But if you feel that you've sort of, I would say, lined your own pockets sufficiently, then that's the time to start thinking about these additional gift-giving ideas, whether it be charity or individuals. And for giving to individuals, essentially, there's all these different techniques and trusts, and they all have funny names like grats and idiots and whatnot. The base point of it is that you are giving away something now that you think is going to highly appreciate over time. So not only are you giving away today what you actually have, so let's just say it's $1 million of a stock, private company. You think that company is going to go through the roof in 5-10 years. You're giving that $1 million away plus that potential future appreciation. And I mentioned it earlier, the exemption. I mean, you only have but relatively speaking, you only have about almost $5.5 million as an individual, or about 11 as a married couple to give away. If you give away that $1 million today and it becomes $10 million in 10 years, you've leveraged that gift in the state tax exemption. You've used $1 million of your exemption, but you've really given away an additional $9 million in appreciation. So that's the fundamental idea when you're talking about the estate tax minimization strategies. That's usually to minimize impact on your estate when you're giving to people. You can also look at a different angle, giving to charity. So a lot of folks already probably have some charitable giving that they do on a regular basis.
You can give to Upward, by the way. That's a charitable organization.
That was my opening for you. So the idea behind that is, there's a couple ideas. I mean, I think there's basic giving where you just cut the check or you go to a fundraiser and you give that charity a small token, right? That is great because it reduces your income tax for that tax year. If you want to look at a bigger picture idea, especially for people in the room who are founders of a company or early C-level, you have an opportunity to potentially give away something that's going to be worth a lot. And it's very complicated in steps, but the general idea is that you might be able to give that asset away before those shares in the company before it's sold to what we call a donor advised fund, or we call it DAF for short. And the idea behind that is that DAF actually qualifies as a charity. It's a 501c3 charity. So when you give, we set up a DAF, it's an account basically. I always think of it like a bank account that the only person who we're ever going to write checks to is the charity or a charity. That account qualifies 501c3. So when you make a contribution to that account, that DAF, that is a tax deduction. So you take that from your income taxes, right? And the really, really good thing about a DAF that I found in personal experience with clients is that if you're about to sell a company and you're just really busy, you don't have time to think about what to do or who do I want to benefit from this charitable gift. My CPA says I need to make a big charitable gift this year to reduce my taxes because of all this cash I'm getting from the sale. It's too much to try to figure out what's my gift strategy for these charities. So the DAF is great. You put the money aside, you get the deduction in that year, you put it aside. But you get to take your sweet time to figure out who you want to give it to. There is no time limit. The minimum is usually negligible. It's like $250 a year that you have to give away. Beyond that, you get to take time to figure out what your goals are and who you want to help out. And ideally, those assets are growing. So the $250,000 you put in, maybe over a few years when you've only given out small gifts, maybe it's now $500,000. Whatever, it's going to be beneficial to that charity. So that's another option of to minimize.
I love that idea. When she told me that, I thought that is exactly what I want to do. Okay, Grace, and then we have another question over on the side.
Yeah. Before I ask my question, what you just talked about, is that similar to the charitable remain trust?
It's similar in the sense that you're giving to charity, but they're very different in benefit and complexity. So the charitable remainder trust is a trust that's irrevocable. So once you set it up, it's a done deal. That is similar to a DAF, because if you give to a DAF, that's a done deal. That money is no longer yours, it belongs to charity. With the charitable remainder trust, though, you're benefiting not just charity, you're also benefiting some other individuals. So you set this trust up for however many years. You could be the beneficiary, or you can name children or others. And essentially, over the term of the trust that you choose, the income comes back to you. So you get income that's generated from this trust. The assets that you put in there, then they generate income. The income stream comes back to you. At the end of the trust term, then the remainder goes to charity. So hence, charitable remainder trust. That's useful for folks. This is what I kind of boil down to. If you are charitable and you're ready to make a charitable gift, but you're not 100% comfortable just giving everything away, you feel more comfortable, at least for some period of time, having an income stream. Let's say to support you till some age where you plan to retire or another payout is coming. Then you can take that income stream in that situation, and it helps relieve the burden of thinking, oh my gosh, I gave it all away. But you still have to be charitably inclined to, I think, have it make any sense whatsoever.
So my question has to do with, how do you find a team to work holistically for you. So, I go to my financial planner. You ask questions has to do with tax, because every financial situation, investment has tax consequences. And they'll say, go to your tax attorney. And I go to my estate attorney and I ask a bunch of questions. They'll say, you go to your tax attorney. So then I realize I need a financial planner, I need a tax attorney, and I need an estate planning attorney.
It's like a whole slew of people.
Can I reduce this to maybe one person or two people, or go
with that challenge, I'd love to meet them. No, I would say that you can help a situation. You can reduce it down to working with one organization that has all that talent within them. And I mean, it's true, like at Credit Suisse we have that. So when I was in private practice, I felt the same, that people worked very piecemeal and they didn't act as a team, because that's just the nature of these people who are CPAs and attorneys. But when I went to work at Credit Suisse a couple of years, 2.5 years ago, one thing I realized at Credit Suisse is that you have, it's mostly financial advisors, right? But then there's people like me in-house who can help with the estate planning side and the income tax side. And you also have people who can do, run like stock option analysis and things like that a CPA might do as well. And at Credit Suisse, and this may be true at other institutions as well, there's a team feeling. So that your financial advisor, if they knew what was good for them, they should take charge of building that professional team. Even if they don't have it in-house, they maybe should be a little more conscientious of the fact that they need to build a rapport with those professionals that you have already or that you need to give you introductions to those people. We do that all the time. And I think that's important because all these people do need to talk to each other to really understand what's the best financial advice to be giving, and not just financial, right? We're talking about like wealth preservation and planning. And so it's a lot more than just which, that's important, which stocks to pick, but it's beyond that. And those people need to work as a team, and your advisor should be taking the lead on that.
And they don't, right? Because I have a financial planner, I have a tax attorney, and I have an accountant. And they don't coordinate or collaborate.
Yeah, so I feel like I'm a general contractor. I define it.
Yeah, and that's not right. You shouldn't. Elaine, you want to?
I'm sorry. You can actually ask your financial advisor to make your CPA an interested party, and then they're going to communicate some quarterly gain loss reports or 1099s, and then they'll include them in your account reviews. So that when it's time to make any tactical changes, and you should be meeting with your advisor at least quarterly. Annual is great, but you should meet quarterly just as a check-in and have your CPA on the phone and you all have one conversation. It's very efficient.
That's good. That's great advice.
That's how Elaine does it.
Yeah.
We have a
here we go. Ask your advisor to do that, and they can add them.
All right, different side of things. So my name is Ayala Goldschmidt. I work at Oracle, so I'm definitely not in your high net worth category.
Not yet.
Sorry, not yet.
Is that an Oracle thing, or is that just there's some wealthy people at Oracle.
Yes, there sure are, but I'm not one of them, I think. And I'm actually really excited to be here today on my first day of maternity leave. I'm, expecting a child in about 4 weeks.
Get out of here. Are you serious?
I will admit to everybody that shame on me. I've been letting my husband run all of our finances and planning, over the years. I have full trust in him, but seeing some of those charts makes me rethink. And really my question is, how should I be planning, for this baby? We're actually also planning for me to become a sole provider. He's gonna actually stay and take care of the baby. What are the kinds of things that I should be thinking of and trying to set up? I already wrote down 529. I have no idea what that is. I wrote down, setting up a trust fund, but where do I get started? Where can I read more about this, and what kind of professionals do I need to seek help from?
Right. Okay. The hard question is, what resources should you use? The problem that I find, at least from my field of estate planning, is that there are so many internet sites and stuff that give you some information, but I feel like it's just enough to be dangerous, and sometimes it's actually wrong. So as hard as it is to say this, I think your first step is really sitting down with an estate planning attorney. They usually charge you from the beginning, but not necessarily. You might be able to get a consultation. The estate planning attorney is the person who's going to draft the estate plan. So they're going to put together the basics, okay? And for you, the basics would be have a revocable trust. That's revocable, so you can change it. And that's that's basically a will substitute in California. So the will doesn't help us here in California because we have a very onerous probate process. So that's that's the court process. When you pass away, what happens to your estate has to go through that, right? So,
and I do have some benefits through work where I had set up with the
yeah.
I sort of
So, I mean, I have, you know, it's just my opinion on it, but I have found, especially when I was in private practice and when I had my own firm, I found that the attorneys, generally speaking, not all of them, that were associated with the services that the big companies give you for legal advice aren't necessarily the most sophisticated. Now, that's not all of them, right? But that to me has just been my experience personally in the Bay Area, right? So it could be different elsewhere, but yeah. Well, because frankly, the attorneys don't get paid that much because the companies negotiate these lower rates. And I always feel like there are two kinds of attorneys who are okay with that. There are ones who are just starting off their business and are willing to just sort of jump in and get things going. And they might have had previous experience at a law firm that taught them a lot. Or the majority are people who are just sort of hang up the shingle, I'll figure estate planning out, no problem. And I'll take whatever I can get. So I caution you to maybe start there, but then see how you feel about the attorneys. Ask them questions about how long have you been in practice. Is your practice predominantly spent on estate planning? If somebody tells you they're a personal injury attorney and they do estate planning, I just get up and leave because it's a bad idea. Nowadays, law work is so specialized that really one needs to focus on a particular area. So start there, but if that doesn't work, you know, talk to your friends if you have any friends who've already gone through estate planning. This is actually to Barbara's point, like we don't talk about money and this kind of stuff enough, but you find that a lot of times people have done things that you just never came up in conversation, right? Maybe they didn't think it was polite or whatever, but I do think it's important to talk. Your friends have personalities like you, they're probably gonna be a good place to start with what kind of personality of attorney you would like to work with. And if that doesn't work, a financial advisor that you know, or maybe it's not your financial advisor, but you know one or you're friendly with one, maybe you can ask them who they use. Sorry, did you want to chime in at the same time?
Actually, we're going to have to wrap on
more
comments on that point.
Yeah, no, that's it.
Okay, excellent. Okay, all right, super last quick question.
529 plan, we set one up. Should grandparents set up their own or feed into the one we have?
I mean, I think they just feed into yours, no problem. I think that's simpler. That's my personal opinion. Yeah, so simple.
Okay, one more question, and then that's the last question.
I think for the two women that just asked the question, I moved here 13 years ago from Canada, and Credit Suisse is my quarterback. Right here, Carrie has invited me to today, and Carrie basically manages all of this and is my quarterback, and there's a huge trust. Credit Suisse has really improved my husband and my lifestyle, so it's all about having somebody you trust and being the coach or quarterback of all of those services. So big hands for Credit Suisse today. And if there's folks in the room that aren't doing business with Credit Suisse, you should be.
That's such a perfect lead-in, because that was actually what I was going to say. We've got a great staff of Credit Suisse folks who are available. If you have more questions, you can stay and hang out. We're out of time today, but you can hang out individually. Or if you have any specific questions that you want to contact somebody specifically, then send a note to me or to Beth Hart, and we'll get you the right person at Credit Suisse to follow up with. So with that, thank you very much to Christine. Thank you to Barbara. She had the lead role. And thank you guys for coming.